I don't think the Fed is responding to that pressure. At least the very senior people at the Fed have told me that it's not. They're responding to the data. Now, look, the president has made his views known as an experienced, successful businessman and investor. So he was not happy and felt they were moving rates too high, too fast.
Presidential economic advisor Larry Kudlow saying the Fed's new wait-and-see approach is not because of pressure from President Trump. To JPMorgan Chase chief economist Anthony Chan. So what do you think, Anthony? Is Powell's sort of change in pathway here, does it have something to do with the pressure he was getting from the White House?
Not at all. I think that the Federal Reserve over time has shown to be pretty independent of the executive branch. And my suspicion is that when you look at the economic statistics, they are slowing down. We know that growth in the second quarter was 4.2%. We got 3.5% in the third quarter, and I think the fourth quarter is probably going to be below 3%. So it's slowing down. And more importantly, if you look at a composite index of over 100 economic indicators, they're falling down. They're not at recession levels, but they're clearly easing. And the Federal Reserve has simply made a comment that if the economy slows down, they will look around and perhaps take a deep breath before going on. But if the economy
when they look around,
chugs along, then they'll keep going.
They have access to a lot of information that most of us don't have access to. They probably foresaw the jobs figure being a disappointment. We have the Fed Governor Brainerd saying just now, this is just crossing the wires as I speak, that the gradual rate hike path will increasingly depend on evolving U.S. outlook. So again, that kind of follows Powell's line that we may take a second look about raising rates.
Well, the way I interpret that is that all they've said, both Rich Clarida and, of course, Chair Powell have said that they're going to move more towards a data-dependent mode in terms of determining policy. And by the way, that's the correct way to do it. If the economy is showing some signs of wobbling or slowing down, and by the way, I think that by 2020, the U.S. economy could very well enter a recession, then you want to be very careful because not doing enough, obviously, can lead to higher inflation, but doing too much can sort of exacerbate the path towards a recession. And all they're saying is if the economy slows down, then we will slow down the pace of Fed tightening, which is, by the way, what everybody would like them to do. Nothing to do with political pressure.
Now, to what extent do they get market pressure? That is, when they look at the stock market going down, do they take that in advisement as one of the measures that they use as to whether they should go faster or slower in terms of raising rates?
Well, you got to keep in mind that the Federal Reserve has two mandates, which is the price and employment. They want to stabilize those two things. But at the same time, they look at financial conditions. Chair Powell has clearly said that. And financial conditions are determined by the value of the currency, the value of equity markets, interest rates. There's a lot of things out there. And it's not so much that they are targeting the stock market, but to the extent that the equity market, interest rates, or even the value of the currency has an impact on the economy, they can't ignore it. And they simply are taking all those things into account in determining policy. But that is different from saying that they are targeting the equity market. They're simply watching it as one of the inputs that goes into the formulation of monetary policy.
Now, of course, you're right. They do have two mandates. They have the price stability mandate, which used to be their only one. And then they had another mandate, a growth mandate that was put in there back in the 1970s, I believe it was. And sometimes they conflict, don't they? I mean, sometimes if they honor one mandate to keep the value of the dollar steady, they violate the growth mandate. So it doesn't always mix well.
Well, remember that Charles Goodhart always told us that when you have a goal, you can't really use monetary policy to satisfy too many goals out there. So it is a delicate balancing act for the Federal Reserve. And right now, if you look at core personal consumption deflator, excluding food and energy, we're actually below the 2% target. The latest numbers showing that inflation is rising at 1.8% year over year. And of course, the target is 2%. And the prior month, the month before that, was 1.9%. So we are clearly below the inflation target of the Fed. So right now, they don't really have to worry. They really have to worry about future inflation. But the last thing I'll say on that, remember, monetary hits the economy with a lag. So what they do today is going to influence the economy a year and a half ago. So it's also incorrect to say that because inflation is low today, that they don't have to do anything, because they're trying to impact the economy a year and a half from now.
Anthony, I'm guessing from what happened yesterday, where we had a 780-point loss at one point, then a Wall Street Journal article came out saying that the Fed might go easier on interest rates, and that practically turned around 100%. I mean, we did end the day down, but only in double digits. Do you think the Fed always trumps other issues, whether they're trade or China or whatever?
I think all these issues are important. There's uncertainty with regard to trade. There's uncertainty with regard to monetary policy. And of course, the instability that we've seen in the equity market is reflective of all that uncertainty. But to the extent that all of a sudden we start to get clarity on trade, get more clarity on monetary policy, the equity market will calm down and that volatility will go down and the fundamentals will be represented. Keep in mind that this year S&P 500 earnings will rise by more than 20%, and that the economy is growing above its potential growth rate.
We don't want to, that's the lead. We always say don't bury the lead. I think that's the lead, the strength of this economy. Chief economist for JPMorgan Chase, Anthony Chan. Great to see you, Anthony. Thank you for being here. Appreciate it.